When you hear the word refinancing, you probably think of long-term homeowners looking to save thousands over the life of their loan. But what if you're only planning to stay in your home for a few more years, or maybe even less? Does refinancing still make sense for short-term homeowners? That's what we're going to explore today. Let's start with the basics. Refinancing simply means replacing your current mortgage with a new one, ideally with better terms. That might mean a lower interest rate, a shorter loan term, or even pulling out some of your home's equity in the form of a cash-out refinance. For many people, refinancing is a way to save money, reduce debt faster, or gain financial flexibility. But for homeowners who don't plan to stay put for long, refinancing can seem like a risky move. Why? Because refinancing comes with costs. You'll usually face closing costs, appraisal fees, and other expenses that can add up to thousands of dollars. If you're going to sell soon, the big question becomes, will you save enough before moving out to make those upfront costs worthwhile? This is where the concept of the break-even point comes in. The break-even point is the time it takes for the money you save each month with your new loan to equal the costs you paid to refinance. For example, if your refinance costs $4,000 in total, but your new mortgage saves you $400 a month, your break-even point is 10 months. That means if you're planning to sell the home in 2 years, you'll not only break even but come out ahead. But if you're planning to move in less than 10 months, you'll end up losing money by refinancing. So the key is timing. But there are specific situations where refinancing actually makes a lot of sense, even if you don't plan to own the home for very long. The first situation is when interest rates drop significantly. If rates are much lower than when you originally got your mortgage, refinancing could slash your monthly payments enough to cover the costs quickly, sometimes within just a few months. Even if you sell a year or two later, the savings can add up. Another scenario is a no-closing cost refinance. Some lenders offer refinances with little to no upfront fees. Instead, the lender may cover the costs or roll them into a slightly higher interest rate. If you know you won't be in the home for long, avoiding those upfront costs can make refinancing far more attractive. Cash-out refinancing is also worth considering. Let's say you're sitting on a lot of equity in your home, but you need funds for another investment, to pay off high-interest debt, or to cover big expenses. A cash-out refinance can give you access to that money while you still own the home. If you plan to sell soon, you can benefit from the liquidity now while still walking away with proceeds from the eventual sale. There's also the question of adjustable-rate mortgages, or ARMs. If you currently have an ARM, and you're worried about your rate adjusting upward in the near future, refinancing into a fixed-rate loan can provide peace of mind. Even if you're only planning to stay for a couple more years, locking in a stable rate might make your monthly payments more predictable and manageable. Finally, refinancing may make sense if the monthly savings are simply too big to ignore. Imagine dropping your mortgage payment by several $100s. Even if you only stay in your home for 1 or 2 years, those savings can quickly outpace the costs of refinancing. Of course, there are times when refinancing is not a smart move for short-term homeowners. If you're going to sell before reaching that break-even point, refinancing will cost you more than it saves. If the interest rate savings are minimal, or if the lender fees are unusually high, it may not be worth the hassle. And don't forget to check whether your current mortgage has prepayment penalties, since those could eat into your potential savings. So how do you make the right decision? Start by calculating your break-even point. Look at the total costs of refinancing and divide by your expected monthly savings. If the time you plan to stay in the home is longer than that break-even point, refinancing can be a good idea. If it's shorter, you may want to skip it. Next, shop around. Don't settle for the first offer you see. Compare multiple lenders, negotiate fees, and ask about no-cost refinancing options. Sometimes lenders will reduce or waive certain costs to earn your business. Also, be clear about your selling timeline. If you know for sure you're moving in a year, refinancing might not make sense unless it's a no-cost option or your monthly savings are huge. But if you're on the fence and think you might stay for 2 or 3 years, refinancing could be the smart move. And remember, refinancing isn't just about the math. It's also about peace of mind. If switching to a fixed-rate loan or reducing your monthly obligations makes your financial life less stressful, that's a benefit you can't always put a number on. So, when does refinancing make sense for short-term homeowners? It makes sense when the savings are substantial, when you can break even before you sell, when you can avoid big upfront costs, when you want to tap into your equity, or when you want the stability of a fixed-rate loan before moving on. But it doesn't make sense when your timeline is too short, the fees are too high, or the savings are too small to make a difference. The bottom line is this: refinancing isn't just for people planning to stay in their homes forever. Even short-term homeowners can benefit as long as they run the numbers, understand their break-even point, and choose the right type of refinance for their situation. So before you dismiss the idea, take a closer look at your own timeline, your goals, and the offers available from lenders. Refinancing could be the smart financial move you didn't think was possible.